A headline about a new top fund can make switching feel completely justified. Fast forward a year, and that once stellar fund appears average, making way for a new frontrunner. The financial landscape thrives on performance chasing, keeping us preoccupied with rankings, ratings, and short timeframes. When individuals take charge of their retirement, this noise can overshadow fundamental principles and essential planning. This behaviour leads to increased trading, elevated costs, and transforms long-term investing into a continuous challenge. It also distracts from the crucial work of saving sufficiently and establishing a portfolio designed to support decades of retirement. During a chaotic week, a decline in portfolio value can spark an urge to sell and quickly buy whatever feels secure at the moment. Conversely, during a calm week, a hot tip might provoke an impulse to act, even when your long-term plan remains intact. This outline will delve into diversification, understanding market reality, asset allocation, low-cost index funds, rebalancing and planning according to spending needs. This video draws inspiration from The New Coffeehouse Investor by Bill Schultheis, so be sure to subscribe for more effective investing strategies. A fundamental shift involves moving away from chasing performance and making decisions that rely less on predictions. Stock prices react to investor emotions and expectations, meaning even favourable business news can drive prices down. When information is already factored into the price, stock picking becomes a gamble based on timing and sentiment rather than straightforward facts. This gamble can lead to failures at any moment, forcing painful transitions between managers and strategies when underperformance occurs. Consider two investors with identical goals. One continuously pursues 5-star rankings, while the other maintains a straightforward, diversified plan. The first investor constantly resets their portfolio after each ranking shift, while the second avoids this disruptive cycle. Ignoring the constant barrage of promotions creates space to focus on the few decisions that genuinely influence long-term results. These pivotal decisions include setting realistic expectations, consistent saving, and crafting a portfolio that aligns with goals instead of headlines. A valuable approach is to clarify what success signifies, then limit how often you check your portfolio to diminish short-term distractions. Use that saved focus to evaluate your diversification and savings instead of hunting for the next top performer. Risk embodies the possibility that your funds won't be available when you need them. This definition makes your time horizon crucial, since a 1-year goal carries different risks than a 30-year goal. A short time frame can't weather significant market fluctuations, while a long horizon must account for inflation's impact over time. Excessive checking can heighten anxiety, while infrequent checks might conceal a portfolio that no longer meets its intended allocation. If your goal is a home down payment next year, investing primarily in stocks could create unnecessary uncertainty. Conversely, if you are planning for retirement down the line, solely relying on cash can erode purchasing power due to inflation. Asset allocation involves distributing investments between stocks, bonds, and cash to align with your timeline effectively. Once your allocation suits your objectives, daily news becomes less relevant, as your portfolio is tailored to weather various market conditions. Clearly define what the money's intended for and establish a timeline for when it will be needed. Then select an allocation that aligns with that timeline. Schedule regular monitoring, such as quarterly reviews, and make adjustments only when the allocation or your goals change. A well-diversified portfolio thrives best when constructed with low-cost index funds that accurately represent various market segments. This strategy seeks to capture the overall returns of each asset class, rather than trying to identify rare exceptions. High fees and frequent trading can gradually diminish long-term wealth, even when the broader market performs well. By owning the entire market average, you minimize regret, since your outcome isn't based on making perfect timing choices. You might opt for a simple setup that includes one fund for broad stock exposure, one for bonds, and some cash for immediate needs. Alternatively, a more complex approach could involve several index funds, each representing distinct portions of the stock market. This structure aids in achieving financial goals with reduced guesswork and fewer emotionally driven decisions. It also aligns with the concept of efficient markets, as it considers attempts to beat the market as unnecessary and risky. Start by identifying the ideal allocation, then select low-cost funds that track each component of that allocation. If developing this straightforward, diversified system resonates with you, subscribe for more insights on applying it effectively over time. Even a diversified portfolio requires ongoing maintenance. Rebalancing is essential to maintain your intended risk level. Rebalancing involves selling a portion of what has appreciated and purchasing what has lagged behind to keep your target allocation consistent. Neglecting rebalancing can lead to an over-concentration in winning assets, leaving you vulnerable to losses in the highest price segments. Rebalancing keeps your portfolio well distributed, shifting the main risk from market volatility to inflation. If stocks rise sharply for a year, a rebalance will trim some stock holdings and restore bonds or cash as originally planned. Conversely, if bonds perform well, the rebalance will direct new investments towards stocks until balance is restored. This disciplined approach helps avoid the temptation to sideline your investments during downturns or chase after excitement during bull markets. It transforms investing into a repeatable process that supports long-term savings and staves off constant strategy changes. Establish a clear rule such as reviewing allocations annually and carry out rebalancing without introducing additional predictions. If you find yourself checking the market daily, limit those checks to just a few times each year, keeping your focus on what truly matters in life. A comprehensive financial plan begins with defining your saving and spending levels, rather than making assumptions about which fund will outperform. Think of your plan as a flight path for retirement, detailing a route and milestones along the way to your destination. Without that defined route, one critical question remains. How much should be saved each month to achieve your financial goals? A sound plan also clarifies the amount you can withdraw in retirement without jeopardizing your portfolio's longevity. One approach is to monitor your monthly burn rate, the spending level that needs coverage during retirement. Once you know your burn rate, you can link saving targets and allocation strategies to a specific, concrete figure instead of relying on guesswork. This strategy links your investment choices directly to your personal objectives, ensuring that diversification and index funds serve a meaningful role. It reinforces the concept of preparing for unexpected challenges by incorporating financial buffers and promoting mindful spending. Document your goals, estimate a baseline for retirement spending, and regularly track your savings progress rather than responding to market noise. Next, develop a sustainable allocation and contribution strategy that you can stick with for the long term, as consistency is your greatest ally. Building lasting wealth relies on a few stable principles rather than the perpetual pursuit of the latest market trend. When you minimize the distractions from Wall Street, you can concentrate on saving, diversifying, and implementing a plan that aligns with your genuine goals. Understanding efficient market theories encourages you to stop trying to outperform the market and instead focus on capturing returns through broad index funds. Proper asset allocation and regular rebalancing keep your risk profile in sync with your investment horizon, ensuring your portfolio is ready when you need access to funds. As this process becomes routine, you will experience reduced decision-making stress, lower fees, and more straightforward progress tracking. This level of stability allows you to focus on your work, family, and personal aspirations beyond just investing, freeing you from being consumed by constant market updates. Begin with a clear plan that outlines your burn rate, savings rate, and an ideal asset allocation that matches your timeline. Automate your contributions, limit how often you check your investments, and set regular rebalancing schedules so your system operates without constant intervention. When you manage the essentials effectively, market fluctuations become mere background noise rather than the primary driver of your decisions. If you're ready for a calm, plan-focused investing approach, subscribe to receive more detailed guides and insights tailored to help you succeed.